This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to L&G Talks. Global credit is back on investors' radar, but the rules of the game have changed. Following the publication of our recent article on this topic, we'll explore the key themes in more detail, from higher yields and tighter spreads to the growing importance of integrating credit, rates, and regional insights. Joining me for today's conversation are Ian Hutchinson, Head of Global Bond Strategies, and Radha Mathur, Fixed Income Investment Specialist, who will share their perspectives on the dynamics shaping global credit markets. So, first up, Ian, you've recently written an article on the return of global credit. What do you mean by saying global credit is back?
In one sense, global credit has never gone away, but what we were trying to get at with the headline is that since 2022 in particular, credit's really shifted back up investors' priorities. You can now get positive real returns by investing in credit. That just wasn't true a few years ago. The old equity mantra of TINA, so there is no alternative to equity, that's dead. Today, investors, they're being paid a much higher yield than a decade ago. Corporate fundamentals, default rates have been really resilient. And so we've got that combination of higher yields combined with resilient credit quality, in our view, make global credit an attractive area within fixed income.
So, Radha, most comebacks happen in a different era to the one they've left. Global credit may be back, but this isn't necessarily a return to the world investors were navigating a decade ago. What's different about today's backdrop?
So in 2022, global yields rose. A lot of investors will remember the UK gilt market turbulence around October 2022, but this very much was a global phenomenon. So since then, we've been very much operating in an environment of higher rates, where higher yields are very much driving that renewed demand for credit. So we've got this environment where there's higher yields, but also higher inflation, higher growth, particularly coming out of the US, but also higher interest rate volatility. And that's quite different to the environment that we saw between the period of 2010 to 2020, which was largely categorized with lower rates but higher credit volatility. We now see something quite opposite, which is higher rates but lower credit volatility. Credit spreads also remain incredibly tight, even with rising geopolitical tensions and higher government bond yields. So with this market backdrop and an environment where those higher rates are very much the normal, returns are not driven solely by falling rates, but looking at credit selection and dispersion as some of the examples are going to become increasingly important for finding ways to generate alpha. Ian, is there anything you'd add?
That sums up where we are so well. But I'm a real kind of student of history, so I think it's probably interesting just to delve into a little bit where we come from and why that environment's changed. If we look at credit for most of the post-Great Financial Crisis era, we've had periods of higher and lower credit volatility, but this credit volatility almost always occurred against a backdrop of historically low rates volatility and falling yields. This is caused really by disinflation. This neutered the need for rate hikes as most Western economies struggled for growth with the collapse of a credit bubble and consumer demand. It was a period that a lot of investors dubbed the Ice Age. You had low growth, low inflation, low real returns for many asset classes. Government bonds generally did pretty well in this period, but it wasn't seen as an enticing environment for yield-hungry credit investors. This all ended with COVID. Well, not COVID itself, but the government response to the crisis. So the economic response to lockdown was to provide massive fiscal stimulus, either in the form of furlough payments in the UK or stimulus checks in the US. This was all facilitated with government borrowing. This was what academics had theorized for years as helicopter money to stimulate the economy. So economic theories would suggest or stipulate what would happen if you threw money from a helicopter. It would be the most direct way of putting it into consumers' pockets, and it would be hugely expansionary. Well, it worked. This created inflationary pressure of the kind that central banks hadn't seen for decades. They're initially slow to react, but with supply constrained first by COVID, then by the conflict in Ukraine, and this year by Iran, input prices increased while COVID checks got spent. Demand and prices rose and yields went in the same direction. The dam finally broke in 2022, with yields rising around the world.
At first glance, tight spreads might suggest there's limited value left to uncover, but you argue in the article that the real story lies beneath the surface. What can investors be potentially missing here?
It's true that spreads are historically tight, but I think the last 4 years of demand, it shows us that there are many, many buyers of credit where the focus is much more on total returns, whether that's real or nominal. And when you look at the yields available, market valuations seem a lot more compelling. So most market yield across global investment grade or global high yield, even emerging markets, they're all typically in the 50th to 75th percentile range over the last 20 years or so. And that's a level that a lot of investors find compelling. We've repeatedly seen that even during periods of market volatility, demand can return quickly when yields are sufficiently attractive. Headline spread levels, they also mask an element of underlying sector dispersion. Differences in valuation across issuers, sectors and regions, they continue to create meaningful opportunities for active investors. In our view, selectivity is increasingly important. The gap between the most expensive and the cheapest areas of the credit market is substantial. So for us, alpha is less about broad market exposure. It's more about identifying relative value opportunities, whether that's the issuer, the sector, or the regional level. The overall opportunity set may still be rich, but that means it requires a more selective and differentiated approach than simply just owning credit beta.
So where do you think active investors can still find an edge?
So in general, our investment philosophy is built on the belief that we can add value by taking advantage of inefficiencies in fixed income markets, whether that be behavioral biases, constrained investors, or focusing on overlooked fundamentals. We believe this presents opportunities for active managers to try generate alpha in all types of market conditions. With this particular market backdrop, we believe there's still sufficient dispersion to drive outperformance. And with spreads being so tight, as Ian mentioned earlier, it's really important to focus and really embrace the idiosyncratic risk opportunities, as well as take advantage of the full breadth of credit research expertise to help identify areas of value and also mitigate risks. Another really important lever is active rates management and ensuring that there's a process that looks at interest rate risk and how that affects credit returns, as well as being its own source of alpha within portfolios. The goal very much isn't just to own more credit, but it's to ensure we're owning the right credit and blending that with an active rates process that can help boost returns and dampen volatility.
You've outlined where the potential opportunities are, but what could challenge the case for global credit from here? What are the key risks investors should be watching most closely?
There's always, many risks to credit markets, but I think the ones that investors should keep that closest eye on, where we're in a world where rates volatility remains high, but higher yields are really explaining a lot of the demand for credit. I think the key threat to credit returns is likely to come from a big shift in rate markets. If the market moves suddenly and materially higher, risk appetite will likely fall. Although possibly that's only temporary. But if rates fall too far, that could be a more persistent problem for credit demand. Geopolitical risk remains much talked about, but outside of major supply shocks, the start of the Ukraine conflict or the Iran conflict this year, investors have shown willingness to look through those events. For example, credit volatility this year in the face of conflict is lower than last year's Liberation Day tariff-induced sell-off. I think one final thing that we should just keep an eye on is hyperscaler supply. Credit markets are generally very good at absorbing large amounts of supply, even if it's from new sources. But just the sheer scale of the capex within hyperscalers is something I think investors should keep an eye on. In 2024, AI-related supply was about 2% of US investment grade market. So far this year, it's about 18%, and we think that's only going to increase. So I think that's something that also needs to be navigated with care.
You argue that the next phase of global credit investing will favor integration rather than silos. What does that mean in practice, and how does it shape the way you're managing global credit portfolios today?
Yes, so we touched upon this point a bit earlier, but we're very much operating in an environment where we're seeing higher interest rate volatility and also higher yields that are driving the demand for credit. So in that environment, having active rates management is incredibly crucial to the process. But it also doesn't make a lot of sense to have different processes and teams for your credit risk and rates risk, but instead ensuring that specialists are working together to form a very disciplined focus that takes into account the impact of rates risk on credit risk and vice versa is incredibly valuable. The second point there is very much that as credit markets continue to evolve and diversify, having local market knowledge is incredibly key, but also ensuring that we maintain strong risk management process. So our solution to that is very much to have a hybrid approach where we allocate capital out to regional teams to benefit from their local market expertise. This also enhances alpha generation and portfolio diversification, but we also retain capital to manage risk, implement our duration strategies, but also ensure that we can amplify the strongest themes from those various regional teams. And what this does, it creates an holistic approach where we're ensuring that allocation, selection, and duration management can be their own independent sources of alpha, and we're not operating within any form of silos.
Looking ahead, what do you think will separate the winners from the losers in global credit over the next few years?
I think we operate in a world where uncertainty and volatility, they're not temporary disruptions, they're the norm. So the winners in global credit are going to be those with broad toolkits, robust investment philosophy, and processes and flexibility to adapt as market regimes change. So being agile, nimble as credit managers instead of predicting, that's going to be key. Also think that those investors that can articulate and act on their philosophies will be the winners in global credit. Understanding where you have an edge is crucial. If you're planning to have sustainable alpha, you should ask yourself, where's your right to win? Is your edge likely to be persistent in a world of AI, shifting flows? So having a clear focus on what you're trying to achieve means that you're best able to adapt to changes in the market structure and information technology. None of us knows what the future is going to hold, but I think it's so important to face it with clarity and with foresight for those hoping to thrive.
Great. Thank you so much. Well, I'm afraid that's all we've got time for today. Thank you both for your time and for a really insightful conversation.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's asset management division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture the global conglomerate that includes, in the European Economic Area, LGIM Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal and General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal and General Investment Management Japan KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal and General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318776W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.